We've got a lot of things to talk about, so I do want to welcome Joe Brusuelas, Principal and Chief Economist at RSM US, joining me in studio. Joe, great to see you.
Good to see you.
It's been a bit since we checked in. What is the current state of play here when it comes to the economy?
Okay, so the economy is absorbing simultaneously several shocks at once. The one that we're going to focus on here is the one that's coursing through the financial system because of those elevated level of tariffs. So we've got an effective 25% tariff on everything. You know, when you take a step back and you think, what's that mean? Because that's a pretty big tax cut. You know what it is? It's the, tax hike. It's the single largest tax hike since World War II. That's why you're seeing the volatility.
Yeah.
Volatility traders, you love it. We're all going to trade gamma. You get to it, right? But the rest of us, well, we're going to have a little bit of indigestion going forward. You know, in many ways, the rhetoric of the administration's bumping up against the harsh reality of how financial markets work. At this point, the administration is trying to find a face-saving way out of this. My sense is at the end of the day, we're going to end up with a 10% tax on all imports in the United States, and we'll probably have a 60% tax or so on China. Now that's still well above the worst case scenario that anybody had prior to Liberation Day.
Interesting.
Okay, so the economy's slowing. At best, it's going to grind to a halt. At worst, we're going to have a mild inventory-led recession. Let me link all of this that's going on in financial markets with the real economy for you. Okay. Markets have sold off. We're on a volatility, a wild roller coaster ride, right?
Yep.
What we're going to see over the next couple of weeks is shipments into the port of LA slow significantly, anywhere between 45 and 50%. That will translate into over the next 4 to 6 weeks, so June into July, the inventory overhang we now will turn into shortages. That's when I think the administration has to provide clarity on the rules of the road. Until we get that clarity, we're just going to have this volatility machine. And again, if you're a volatility trader, congratulations. It's your career moment. For everybody else, though, this is just going to be a very trying time.
So in terms of that, Joe, of course, the president can make changes as he pleases. He is the leader of the free world here. For companies and consumers, you know, they're not as agile, let's say, as the president in the Oval Office. So how do you anticipate companies will need to respond to this in the weeks ahead? Okay,
well, we saw that this week in the earnings. What's been the big theme? Even as the markets are up and we're all encouraged and happy that's happening, lack of forward guidance. There's just too much uncertainty on the table. What that tells me is you're going to see a pretty big pullback in investment in software equipment, intellectual property, that's productivity enhancing investment, start fairly soon. My sense is in the April data that we see in May, the new orders data in particular, you're going to see that fall off the cliff, right? We can already sort of see it setting up. And then you're going to see once the orders fall, then price will go up. Look, we're looking probably 5 to 6% on CPI here within 90 days.
Interesting.
Yeah, and that's when the public will become engaged. And then what we'll be looking for is an increase in initial claims. Yesterday it was at 222, right on top of the 13-week moving average. So all good there for now. But we're going to be looking at a whole host of indicators. And that shipping indicator I gave you, that's really the tip of the spear here for investors.
Interesting. Shipping, CPI. What does this mean? Volatility likely to remain. We're just about at where a correction would be. An 11% drop from the S&P 500. We had hit a 20% pullback. But with this particular forecast, Joe, do you anticipate that we could see a leg lower in the markets?
Oh, without a doubt. Simply because the daily pivots, the U-turns, the inconsistency in the story from the main players on the U.S. side. You know, we talk a lot about the U.S. negotiating with China. And if you take a step back at this and look at it with a cold-eyed, sober view, we're negotiating with each other. I'm not sure what the strategy is. I don't think there is one. Or do we have a clear sign of what the objectives, much less goals and timetables are? So more volatility, not less. And again, at one point, I think that the escalation ladder, that escalation dominance that the Trump administration thought they had, turns out they didn't have the cards. So we're going to have to watch a rather painful climbing down of that, every rung of that ladder until we get to a steady state. And again, I think that is 10% tax on all things coming into the country. right? And then probably 60% on China, and then we'll see how long it takes to negotiate all of these deals, if indeed deals can be negotiated.
So at what point then would you anticipate that the Fed would step in if inflation in 90 days does hit 5 or 6%?
Okay, so let's talk about the playbook when there's pressure on both sides of the mandate. What that means is with inflation going up and unemployment likely to rise, you've got stagflation-like conditions. Their playbook tells them that under those conditions, you lean into the portion of your mandate that's furthest away from its target. That would be inflation. Therefore, rates are going to be held steady for quite a good period of time. The Fed won't cut rates until it sees real cracks in that labor market. My sense is we don't see those till mid to late summer, and we probably get a September rate cut, if indeed the labor market cracks. But remember, we're just below full employment. 4.2, 4.3 is the Fed's call on full employment. I think the unemployment rate increases to that point a week from today, right? And then we'll see where it goes from there. We could have a recession without unemployment really rising too much, which for traders, that might be the worst of all worlds, where they don't get the rate cut in the timely fashion they want, and then that would indeed trigger a larger correction. Let's hope we don't get to that point.
Joe Brusuelas joining us in studio. He's the principal and chief economist at RSM US. Joe, you'll have to check in with us, of course, throughout this process. Thanks for joining.
Thank you.